Welcome back to On the Beat, everyone. I'm over here with Jeff Farnham, the owner of JTS and Company Mortgage Brokers. We're talking about the difference in fees. How are you, my friend?
I'm well.
Now, look, I know there's a lot of conversation out there, and we see a lot of advertising in regards to what is the right amount to put down for a deposit on a home. Is it 0? Is it 10? Is it 20? I don't know.
Yeah.
I get confused.
Right. So there's so many different variations out there, right? And we're talking about down payment, and they're really going to depend on the type of loan that a borrower qualifies for, right? So there's 4 major categories of loans to consider. Conventional loan, then you have government-insured loans like FHA, VA, and rural development. 2 of those don't require a down payment at all. VA and rural development doesn't require a down payment. You can actually do 100% financing under those programs. FHA is going to require someone to put 3.5% down, and then conventional can be anywhere from 3 to 5 to 20. And under any of those scenarios, you can put down as much as you want to, but you're not required to put down that much. And people still have the misconception that they've got to put down 20%, and that's just not the case.
Okay, if it's 0 down, I would assume you have to take out mortgage insurance?
Yeah, so on your government-insured loans, the FHA and the rural development loan, there's going to be a monthly mortgage insurance component that you're going to pay. And then on conventional loans, unless you put 20% down, you're going to pay a monthly mortgage insurance. And that just insures the lender between what you do put down and an 80% loan-to-value.
I want to ask you, Jeff, you were just talking about mortgage insurance. What does it actually do and who does it protect?
Well, mortgage insurance is for the benefit of the lender, right?
Okay.
But it's a tool, and it also benefits the consumer. Because the consumer, the alternative is to put 20% down. And when we're talking about starter homes today, and we're talking about home prices today being $150,000, $175,000, $200,000, $300,000, $400,000, putting 20% down sometimes is just not possible. So a borrower can get in with as little as 3% or 5% down, but they'll pay what's called a monthly mortgage insurance premium. And that's added to the loan to protect the lender, right? In case someone defaults, it's not going to pay the loan off, but it's going to help the lender recover some losses.
Right, but you would also calculate that into the mortgage costs?
Absolutely.
Okay, all right. What are prepaid items?
So prepaid items are things that you're going to prepay in advance as a condition of getting the loan closed. You're going to prepay your insurance up for the first year. You're going to prepay into an escrow account to cover taxes and insurance. So every month when you're making your payment, you're paying the principal and interest, plus you're paying 1/12 of insurance, 1/12 of taxes, and the monthly mortgage insurance if you have it. And that goes into, the insurance and taxes goes into an escrow account or a forced savings account.
Okay.
So this time next year, when the insurance comes due, when taxes come due in January, we're going to pay those for you, and you don't have to worry about that.
Okay, that sounds like a lot to absorb. That's why we have people like you. What makes up closing costs? I don't know what they are.
Yeah, so really, there's 3 things that determine how much money you need to close. That's called cash to close. How much do I need to go to the closing table? So you have your down payment, your closing cost, and your prepaid items. So closing costs are one-time charges, things you're going to pay one time as a condition of getting that loan. Things like an appraisal, an attorney fee, an origination charge, or an underwriting fee. You're going to pay those things one time, a credit report fee one time. The loan's going to be closed. You're not going to pay those again relative to that loan.
Are any of those costs that you were talking about negotiable?
Yeah, I mean, well, some are, right, depending on the situation. Things like appraisal fees, credit report fees, attorney fees, those are static, right? They are what they are, right? But sometimes we can use the origination charge or the interest rate as a tool to help your specific situation, right? So if you're only planning on being in the home 3 years, 4 years, 5 years, it may not make sense to pay an origination charge, right?
Okay.
So take a little bit higher interest rate because the cost savings is going to be there through by not paying the upfront fee, right? But if you're going to stay in the home 30 years, paying an origination charge, or 10 years or 20, whatever the number may be, paying that origination charge to buy the rate down may make more sense. And that's why it's so important to sit down and talk face to face and deal local, because you need to understand these things, because everybody hangs their hat on, well, I want the lowest interest rate.
Yeah.
Well, lowest interest rate doesn't always make sense.
I was going to say, it might not work for that situation.
Absolutely, yeah.
As always, great information. We truly appreciate you.
Yep.
If you want to find out more, there it all is up on the screen. Everyone, go over and see Jeff from JTS and Company Mortgage Professionals. You're watching On The Beat. We'll be back after this short break.